This conversation is powered by Google Illuminate. Check out illuminate.google.com for more. Today's discussion delves into the Federal Reserve's Board of Governors and their extensive powers, as outlined in Section 11 of the Federal Reserve Act. It's a complex area, but crucial to understanding U.S. monetary policy.
Indeed. Section 11 grants the board significant authority, impacting everything from bank examinations to the very issuance of Federal Reserve notes.
Let's start with the board's power to examine banks. How does this examination process work, and what's its significance?
The board has the discretion to examine the books and affairs of both Federal Reserve banks and member banks, demanding reports as needed. This ensures financial stability and accountability within the system.
And the publication of weekly statements? What information is revealed, and why is transparency so important?
These statements detail the assets and liabilities of Federal Reserve banks, providing crucial transparency to the public and fostering trust in the system.
The Act also details the board's authority to require reports from depository institutions. Can you elaborate on the scope and purpose of these reporting requirements?
The board can demand reports on assets and liabilities at intervals they deem necessary. This allows them to monitor and control monetary and credit aggregates, crucial for effective monetary policy. The reporting is tailored, with different requirements for different classes of institutions.
This seems to involve a significant amount of data collection. How does the board manage this, and what measures are in place to avoid unnecessary burdens on reporting institutions?
The board strives to minimize burdens and avoid duplication with other reporting requirements. They also classify institutions to tailor reporting demands appropriately. Data from other government agencies is leveraged where possible.
Section 11B addresses rediscounts between Federal Reserve banks. What does this entail, and under what conditions can it occur?
It allows, or in certain cases requires, one Federal Reserve bank to rediscount the discounted paper of another. This is a mechanism for interbank liquidity management, with interest rates set by the board. A 5-member affirmative vote is required for mandatory rediscounts.
The board also has the power to suspend reserve requirements. What are the circumstances under which this authority might be exercised, and for how long?
The board can suspend reserve requirements for up to 30 days, renewable in 15-day increments. This is an emergency tool used to address exceptional circumstances impacting the financial system's liquidity.
Section 11D touches on the supervision and regulation of Federal Reserve note issuance. Can you explain the board's role in this process?
The board, working with the Treasury Secretary, oversees the issuance and retirement of Federal Reserve notes, setting rules and regulations for their delivery to Federal Reserve agents. This is fundamental to the nation's currency supply.
The board can also reclassify reserve cities. What is the significance of this power, and how does it relate to reserve requirements?
This power allows the board to adjust the number and classification of reserve cities, impacting the reserve requirements for national banking associations in those cities. It's a tool for managing banking reserves and liquidity.
Section 11 grants the board the power to suspend or remove officers and directors of Federal Reserve banks. What are the grounds for such actions?
The board can remove officers or directors for violating provisions of the Federal Reserve Act. The cause for removal must be communicated in writing to the individual and the bank.
The board can also require the write-off of doubtful or worthless assets from Federal Reserve banks' books. Why is this important for maintaining financial health?
This ensures accurate accounting and prevents the accumulation of bad debt, maintaining the financial integrity and stability of the Federal Reserve banks.
The board has the authority to suspend, liquidate, or reorganize Federal Reserve banks. What triggers such drastic measures?
This power is used as a last resort for serious violations of the Federal Reserve Act. The board can take possession of a bank, administer it during suspension, and ultimately liquidate or reorganize it if necessary.
Section 11I highlights the board's power to create rules and regulations. What is the scope of this authority, and how does it support the board's overall functions?
The board sets rules for safeguarding collateral and other assets held by Federal Reserve agents. This broad rulemaking power is essential for effective oversight and management of the entire system.
The board can also delegate functions. What types of functions can be delegated, and to whom?
The board can delegate functions, excluding rulemaking and monetary policy decisions, to administrative law judges, board members, employees, or Federal Reserve banks. This delegation is subject to the Administrative Procedure Act and is overseen by the chairman.
Section 11R addresses the employment of personnel by the board. What is the process for hiring and compensating these employees?
The board hires attorneys, experts, and other staff as needed, setting salaries in advance. The hiring process is largely independent of standard civil service regulations, though the president retains the option to place employees in the classified service.
A previous subsection, now repealed, dealt with loans by member banks on stock or bond collateral. What was the purpose of this provision and why was it repealed?
The repealed subsection regulated loans secured by stock or bond collateral. Its repeal reflects changes in banking regulations and practices over time.
Section 11N grants the board the power to examine depository institutions and their affiliates. In what context is this authority exercised?
This power is used in connection with advances, discounts, or requests for such from depository institutions under the Federal Reserve Act. It allows for thorough due diligence and risk assessment.
The board can appoint the FDIC as conservator or receiver for a state member bank. What circumstances would lead to such an appointment?
This authority is exercised under specific conditions outlined in the Federal Deposit Insurance Act, typically when a state member bank faces severe financial distress requiring intervention.
Section 11P clarifies the board's legal standing. How does this provision empower the board in legal actions?
It allows the board to act in its own name and through its own attorneys to enforce provisions of the Federal Reserve Act, regulations, and other relevant laws. This ensures the board can effectively pursue legal action to protect its regulatory authority.
Section 11Q addresses the protection of Federal Reserve facilities. What authority is granted to personnel in this context?
This section authorizes personnel to act as law enforcement officers to protect board and Federal Reserve Bank premises, personnel, and operations. This includes the authority to carry firearms and make arrests under specific circumstances, subject to regulations approved by the Attorney General.
Section 11R addresses situations where a sufficient number of board members are unavailable. How does this provision ensure the board can still function effectively?
If fewer than 5 members are available, unanimous consent from the available members can authorize actions, provided certain conditions are met, including documentation of the exigent circumstances and notification to relevant congressional committees. This ensures continuity of operations during emergencies.
Section 11 mandates transparency regarding emergency credit facilities, what information must be disclosed, and under what timeline.
This section requires the disclosure of borrower names, amounts borrowed, interest rates, and collateral information related to emergency credit facilities and open market operations. The timeline for disclosure varies depending on the type of transaction.
There's a second subsection concerning assessments and fees for certain companies. Can you explain this provision?
This subsection mandates that the board collect assessments from large bank holding companies, savings and loan holding companies, and non-bank financial companies to cover the board's supervisory and regulatory expenses related to these entities. The amounts are tailored to reflect changes in regulatory responsibilities.
The Act also includes provisions for a study on the impact of FOIA exemptions on public access to information. What is the purpose of this study?
The Inspector General is tasked with studying the impact of FOIA exemptions on public access to information about emergency credit facilities and making recommendations on whether these exemptions should remain in effect. This ensures a balance between transparency and the need to protect sensitive information.
This discussion has highlighted the breadth and depth of the Board of Governors' powers. The intricate details of Section 11 underscore the complexity of managing the U.S. financial system.
Precisely. The powers outlined in Section 11 are essential for maintaining the stability and integrity of the U.S. financial system. The careful balance between oversight and avoiding undue burdens on institutions is crucial.
That was a great discussion. Thank you for your insights.